following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope everyone out there is having a fun and successful and indeed safe trading week. My name is Mark Longo from the OptionsInsider.com, as well as many of the programs here on the old Options Insider Radio Network. And I am joined, as always, here on the program by my boon companion, the yin to my yang, good old Don Schlesinger from the Volatility Exchange. Don, how are you doing out there in the frozen East?
Well, we're doing just great. We're recovering from that freak storm of a couple of days before Halloween, which really did a great deal of damage in the area, caused tremendous power outages, some of which just got resolved recently, and also, unfortunately, quite a bit of damage to some of the trees around that still had leaves on them and really couldn't take the weight of the leaves and this very heavy, wet snow. But it seemed as if to compensate, the very next day we had a stretch of extraordinary weather that lasted the entire week and probably at least till Thursday of this week, with beautiful, clear skies, no clouds, bright sunshine, which is also kind of unusual for here in October and November. So it's as if they're trying to pay us back a little bit for all the aggravation.
Yeah, it's nice and sunny here today in Chicago. It's been about 60 degrees the last couple of days. Of course, that seems chilly to me because I just got back from a nice sojourn in sunny Florida, and I am rested and relaxed and perhaps...
That's right, rub it in.
Perhaps slightly tanned, and I couldn't have picked a better time to go because, of course, you guys were getting belted over there in the East while I was relaxing poolside there in Florida and taking in a few theme parks with the old little man there. It was a fun trip. I wish I was gallivanting through the parks right now, but duty calls, and I am here yet again to hold down the reins here on Volatility Views.
Yeah, I know you're equally excited. Lounging by the pool in Florida or doing Volatility Views, it's about equal.
Don, huh? You're always exciting to talk to. All right, and with our panel assembled and the team ready to go, we're going to dive right into the Volatility Review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we sit back and discuss the minute intricacies of volatility over the past week. And Don, it was a fun week. It was a good week to be gone, or perhaps a bad week to be gone, depending on your point of view, because there was a lot going on in the world of volatility. When I left, the good old VIX cash was hovering around the mid to low 20s. It seemed like we may have finally seen the great exhale from the market and the lessening of the overall volatility levels. Of course, since then, there's been quite a bit of up and down, and a lot of that due to our friend over there in Greece, and I'm sure you'll discuss that when you get to your Euro vol review. But just a lot of up and down in the old market, and of course, as we record this right now, which is on a Monday afternoon here in Chicago, the good old VIX cash has crept up north yet again. It's up about 6% right now, or nearly 2 points to about 32 even. So VIX cash and the VIX in general have been on just quite the roller coaster ride. And of course, if you look at the VIX in context, here we are hovering around 1250 in the S&P right now, and these are with the VIX at 32 and the S&P at 1250. This is a relatively sizable level of volatility for the overall market. And of course, we here on this program always like to look at the VIX and other volatility measures in context, as opposed to just throwing out these numbers and letting them spin in the ether by themselves. So, Don, were you watching a lot of the VIX in action and just the S&P general vol action over the past week, or were you focused razor-like on your Euro contracts?
No, we're always very interested in volatility in general, so all aspects. And again, as you mentioned, we were at those 32 levels not all so long ago. And as you said, as the market started to climb and we had some nice rallies, VIX retreated quite a bit, as is often the case. I'm going to talk a little later about that negative correlation with equities and some of the hedging aspects of using volatility products. But again, as we started to sell off and with further concerns, not only about Greece, but now today about Italy as well, you see that bounce right back to the 32 level. And, again, just to put it in context for everyone, S&P at 1250, 2% is 25 points a day. And when you talk about 32 volatility, whether it's implied or realized volatility, you're basically looking, again, using that square root of 252 as a daily indicator. 16% annualized is about 1% movement per day if you're looking at volatility. So 32% current levels of VIX would be 2% a day. And 2% a day on the S&P is 25 points daily. So it's once again as if people are forecasting or at least willing to trade options premiums at levels that would indicate that we're going to have on average 25-point moves in the S&P every single day. Now, whether you agree with that or not is a separate issue, but that's what the actual number means, and that's how people should look at it when they're trading options to decide whether or not these are premiums that you think, you're more comfortable buying or selling or just sitting on the sidelines. But that's the context that you have to kind of look at these levels at.
Exactly, and we are currently lagging that 25 handle level right now. The S&P is, like I said, hovering around 12.5, down the number of the beast today, down 6.66 points, or about half of 1% right now. So we are lagging behind our expected 25 handle swing. So we'll see if we get some more activity towards the end of the day to justify these crazy levels of implied vol that we're looking at overall here in the marketplace. And of course, Don, I mentioned I was on vacation last week, and it was an interesting week to be on vacation. A lot of developments in the world of options and derivatives in general. Of course, we had the ongoing saga of Greece that was continuing to breathe fire into the marketplace and send the VIX all over the place and volatility in general all over the place. Of course, from our bailiwick, the options and derivatives perspective, we had the Man financial implosion and all the impacts that has on the business in general, and just, of course, Groupon going public, and everyone wants to know when the options are going to be listed on that. So it was a very interesting week to be away from the scene, so to speak. So it's nice to be back. And of course, I'm sure you were glued to your screens last week as our friend over there in Greece continued to run off at the mouth and just continued to set the euro on fire and kick in some volatility. So, Don, what did you watch over the past week for your Euro vol review?
Well, we did have an expiration of the front month November 1 vol, or 1 month realized volatility contract. And as you so correctly pointed out, the European situation is certainly bouncing the euro all over the place. And so we had the expiration this past Friday, and the contract expired or settled to 15.03, and that is by far of the 9 one-month expirations that we've had since we brought the product out at the beginning of February of this year. That is way above any prior expiration value that we had, the highest of which a few months ago was only 12.77. So this 1503, you could kind of say, was somewhat off the charts and represented the very highest settlement price or expiration value since we began. I would also point out, as we often do, about the swings that occur within the holding period or the realized volatility period of the instrument. At this one was sort of like a double doozy. We had a low to high movement of just a little over 39%. And then off of that high, we had a drop back down of 30%. So you had a lot of action if you decided you wanted to trade this particular product this past month. And I guess that's not surprising with the settlement at 15, that it indicated there was a great deal of volatility during the entire 24 trading day period of this particular contract. So I guess towards the end of the show, we'll talk a little bit about what may be in store for the future and for the December products, but it surely was an interesting week.
Yeah, if ever there was a time to wet your whistle and pique your interest, as it were, in perhaps diving into the Euro contracts, then this has got to be it. There's just so much going on out there right now, and so much volatility, and so much volatility of volatility, as we discuss every week in that Euro VolContract. The thing just is a roller coaster. I know I've said that before. I'm starting to repeat myself, but there are few other apt terms to describe that level of just volatility across the board there in those Euro VolContracts. So if you're looking for a contract that definitely moves and has some action, then I think you could do much worse than looking at the old Euro Vol contracts right now. And given the feedback we're hearing from the show and from people we meet at various conferences and events, and I'm sure you hear this as well, Don, that is definitely starting to pique some people's interest, that indeed these contracts are moving. They're not perhaps the staid animal that a lot of people suspected when you first launched them, that once you get a few days under their belt, that's pretty much it. They're locked in at that relative volatility range. No, these things move, and they move substantially.
Yeah, it kind of speaks to what we've referred to many times as the volatility of volatility. Don't forget the underlying product here is volatility, realized volatility. So that's an instrument or an asset class like anything else. And so you can ask yourself, well, what is the volatility of that particular instrument? It becomes the vol of vol. And we know that not only for the euro, but for equities and for many other products, especially short term, for these 1 month products, that number can be upwards of 100%. So those are numbers that perhaps listeners are not accustomed to in terms of day-to-day trading, but you can get some very high volatility numbers for the product of volatility itself.
All right, Don, and that is going to do it for our volatility review this week. And now we're going to roll right into our Volatility Viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And welcome to the Volatility Viewpoint portion of the show. This is, of course, where Don and I sit back in our chairs by the fire and pick up our brandy snifters and put on our smoking jackets and discuss at length some topic from the world of volatility and volatility trading. And this week's topic is actually something that Don and I have parsed a little bit off the show and just our regular conversations about what we're going to talk about. And of course, some people have brought this up to me in various other venues and platforms, and we've received some feedback on our site, and I'm sure you have as well, Don, over at volex.us, about just some of the general implementation and I think hedging techniques that come along. And when people want to dive into the world, the land of vol contracts, as it were, and start adding these things to their portfolios, whether it be on the equity side and they're looking to hedge some vol risk in a general equity portfolio, or maybe they're looking at specifically at the currencies with the Euro vol contracts, we're receiving a lot of feedback and a lot of questions about exactly how to incorporate these types of products into, let's say, a broad equity portfolio, or if you're an options market maker and you want to use them to hedge, perhaps specifically in the Euro contract, how to incorporate them, perhaps some correlation issues, as well as some typical logistical things like the multipliers and all that sort of thing. So, Don, I know we've discussed this in the past, you and I, but we haven't actually chatted about it on the shows. I think it's time to illuminate our listeners about some of these various aspects that they might want to consider when they're looking to add vol contracts into their portfolio for the first time.
Well, thanks, Mark. I think there is a good deal of interest in this, and some of the actual kinds of hedges can actually be different from one asset class to the other. So it would be perfect, actually, to point that out in talking about currency and the euro in particular, and then switching over to equity and talking about those correlations and how things might work. And I'm going to kind of focus on two areas: using vol contracts in conjunction with any kind of options position, a hedged position like a straddle or a strangle, a market maker might have on his books, or a retail trader, or even professional upstairs institutional traders, as they keep hedged positions in a large number of different underlyings and through the use of options. And then maybe switch over to the portfolio manager or a hedge fund manager, perhaps managing, let's say, an equity position, and talking about the use of potentially vol contracts on equity or equity indices, also in conjunction with the difference between upside, downside, correlation, etc. So one of the things that I find interesting about the options position is that right now you're seeing this great volatility in the euro. And we might suppose a market maker or an options trader who's got straddles or strangles with euro options and trying to actually keep them delta neutral, hedge them, capture the underlying volatility of the asset, which is the euro currency, through that delta neutral procedure, that hedging procedure, and might want to incorporate a vol contract in order to actually hedge the exposure from such a procedure. And so basically, if you've got exposure as a market maker and things get a little bit one-sided and it becomes difficult to hedge, you might incorporate the vol contract into your overall strategy. And one of the things that we find repeatedly when we talk to friends who may use VIX now, that of course would be more so in an equity market, but the principle is the same, is that as you kind of come down to the wire and as you reach a point in the life of the options position where you may be the next to the last day or the last day, you find that there's a very big change or a switch in the sensitivity of your options to changes in that implied volatility if you're using VIX. And most of our listeners know that as options reach their expiration, the implied volatility value that you may input into a formula for valuation really stops having very much significance. You know, in the extreme, if you've got 5 minutes to go to expiration, you can go ahead and use any implied volatility input you care to, and it's not going to change the value of the option at all at that point because it's 5 minutes away from expiring either worthless or to intrinsic value, and the concept of implied volatility just really isn't relevant at that particular point. So if you're trying to hedge something with any type of VIX product, we know that when VIX futures expire, they actually expire to a value that's a forecast of something that's coming down the line 30 days from now. That final number, that's a settlement price for the front month VIX futures contract, is actually, if you will, a kind of a conglomerate or estimate of what next month's 30-day future forward-looking volatility is going to be. And so I'd submit to you that that's just of no help whatsoever in hedging the exposure of an options position, such as a straddle or a strangle, that could move in the next hour or 10 minutes or 15 minutes, and giving you exposure not to volatility, but to direction. In other words, gamma exposure. And so one of the things that we see as a rather stunning attribute of a realized volatility product, such as a VolContract, is that it sort of gives you the best of both worlds. Earlier on, with more time to go to expiration, the product behaves in some ways similar to a VIX product and will certainly hedge volatility exposure, both implied and realized. But as you come down to the end, the hybrid nature of a VolContract is that it will actually hedge somewhat this gamma exposure as well. So you sort of get like two features for the price of one. And how would that work? Well, suppose you've got a straddle on, and suppose you're close to the strike price, and you know that as we head into expiration, any movement at all, one direction or the other, away from the strike price is going to create some value, intrinsic value, for the final settlement or expiration value of the straddle. So if all of a sudden you were to get any kind of a precipitous move right towards the end going into the expiration, that could have an extremely big impact, either positive or negative, on the ultimate value and the settlement price of the options at expiration. Well, again, VIX isn't going to capture that in any way at all. But a VolContract will, because we've repeatedly talked about how even if you've logged 19 or 20 days into the actual calculation of the settlement price of a VolContract, one big day at the end can still have a very big impact on the settlement price of the VolContract. We've given examples where a 3 to 4% movement in the underlying on the last day could change the value of the VolContract from its partial vol to its final settlement vol by as much as 20% or so. So by having that on as a hedge, let's say against a short straddle position and long a VolContract, you really are still in the ball game with your hedge. Whereas if your straddle undergoes a significant price change towards the end of its life, you've got a VolContract kind of paired off with it, which will also give you significant price change in the opposite direction if you're short a straddle and long a VolContract, in order to offset some of that last-minute volatility, if you will.
You know, that's an interesting point you bring up, because we don't hear many people really discussing or mentioning different ways that people can actually hedge that gamma exposure, and we hear a lot of people looking for that and looking for products that can take them down to the wire, as it were, and as you mentioned, in those final minutes of expiration when things are really crazy and your gamma measures really explode out of control. Those are the times when you really need something that can help you offset that type of gamma explosion. So the fact that something like a VolContract can track down to that last minute, I think is would be very beneficial for a lot of those active market makers, as well as some of the really, really active high-end savvy retail guys who know about gamma and gamma scalping and know the need to hedge that and can use the product to its extent. So I think that's an interesting point you bring up, and one that probably doesn't get enough discussion, because it's an interesting value added that isn't really out there in many other instances, at least none that I can think of.
Yeah, well, thank you. And we really think that it's a unique feature of such a product because, again, it isn't a knock on VIX. You use VIX for whatever you want to, but it's simply the nature of the animal, the nature of the beast. As you're expiring with a VIX futures contract, yet again, you're expiring to a kind of a 30-day forecast of future volatility. And that's just not what you want in this particular situation. You want something that's going to move with certainty to an actual calculation in tandem with the movement of the underlying that you're experiencing, and that is affecting the value of your straddle that's about to settle. The last thing that I want want is to have a hedge that's going to be completely reliant upon, what people are guessing is going to be the next 30 days worth of volatility. That can be all over the map. It could be higher, lower. It could be unchanged. People could say, I don't care what's happening in the next 5 minutes. That's not going to change my valuation for the next 30 days. And yet I need a product, if I'm going to call it a hedge of any kind whatsoever, that in fact will react to exactly the price movement of the underlying that I'm experiencing right now. So again, this is an interesting part of the overall hedging activity that you can do with VolContracts. The second area that I'd like to discuss briefly, we've touched upon it before, is using a VolContract, especially one that may have an interesting negative correlation to the underlying, when we would talk about, for example, an equity portfolio. So supposing you're a portfolio manager, you have a portfolio of equities, maybe it tracks one of the major indices, maybe it's high tech, it tracks NASDAQ or blue chip, the Dow, or broader markets such as the S&P or the Russell, whatever. You've got this portfolio of stocks and you've decided that you'd also like to try to mitigate or tame somewhat the overall volatility of that portfolio. One of the ways to do it, of course, would be through the holding of a VolContract on some sort of equity product or equity index. We don't have them available right now, but again, we certainly look forward to the day not very far into the future when we will offer such products. And here, what we have is the well-known, very highly negative 80% correlation between equity movement and the volatility of that equity, whatever the index might be. And so if you're hedging, you run into the situation where you feel that most of the time when the portfolio value will go up, volatility will be declining. If you held a VolContract as a hedge, it would work the way you would expect it to. You'd make money on your long portfolio, but you'd expect to lose some money as volatility would drop. And conversely, when when equity would drop, when the market would drop, you would expect that negative correlation that we see so often, that we're seeing today in the market, that we see time and time again. Stock prices drop, volatility, both implied and historical or realized, increases or goes higher. So if you're holding that as a hedge, you're losing money on the stocks, but hopefully you're making money on your long volatility product, and therefore somewhat offsetting a loss to the portfolio. Well, you mentioned earlier about the mechanics of this. How would I actually know what kind of a hedge to set? And that turns out to be somewhat of a challenge, and we have often acknowledged that there's a great difference between this kind of a perceived hedge and the absolute kind of hedge that you get when you own a put, perhaps slightly below the market or out of the money, which is the classical way to hedge downside movement. Doesn't do a heck of a lot for upside. You simply may lose some value on the put as the underlying goes up, but there's no correlation, particularly if the put eventually goes to zero and expires worthless. But when you're holding a VolContract, you have this two-sided action. Big problem is, what are the numbers? What are the mechanics? How do you actually figure out this kind of a hedge? And I'm going to be the first one to tell you that it's not 100% science. And I'd like to kind of give an example that our listeners can kind of sort of follow along with. It's well known that this negative correlation exists, but it's also sort of well known, and I would invite our listeners to just be good observers on days like this or any day where there's substantial market movement, to take a look at how something that gauges volatility, such as the VIX, moves when the market moves up as opposed to when it moves down. And what we find is that the moves are not symmetrical. By that I mean, if the market were to move up 1% or up 2%, there would be some corresponding movement percentage-wise in the VIX. And then if the market were to move down 1% or down 2% or 3%, there would also be a corresponding percentage-wise movement in the VIX. But it wouldn't be the same as the upside movement for the identical move in the index. And so what we find is that to the upside, the market moves 1 or 2%. The multiple for the movement in VIX is usually about 3 or 4 times, which would mean the market moved 1%, VIX might drop, and it might drop by 3 or 4%. If the market moved up 2%, VIX might drop by, let us say, 4 times that, or 8%. And there's no law here. It's not a formula. It's just something that's observable from empirical data. To the downside, we see something different. So we see, for example, I looked a little earlier. You had more recent figures, Mark, but there was a point today when the index S&P was down about 1%. Was down about 12 handles on the 1250 index. And at that time, VIX that started the day at 30 actually was a little bit higher than 32. So 2 points on 30 or 1 on 15 is about 6 2/3. That was almost 7% movement in the VIX to the upside when the index had moved down only 1%. So there was a 7-to-1 ratio. And very often when we see days where the index is down, let us say 2% or more, the corresponding movement in the VIX can be as much as 14, 15, 16%, or let us say an 8-to-1 ratio. So you have this asymmetry or lack of symmetry, and that can prove somewhat challenging because I can only choose some number to be my hedge when I go out and buy a vol contract for my equity portfolio. So what's it going to be? Is it going to be 4% to 1%? Is it going to be 6%? There's some sort of ratio that I've got to do in order to actually go out and effectuate the hedge, but I'm not quite sure what it should be. So people generally kind of settle more for the higher number and look at about at least 4, 5, if not 6% differential, simply because they're already long their portfolios. They're already going to make money if the market goes up. And so the amount that they would lose to the downside through the hedge, they're looking to really have that hold up insofar as the downside movement of the equities is concerned. They don't want to be shortchanged when you start going down on the stock side. So they'll sometimes set up as much as 6-to-1 in the ratio in order to be able to make sure that when the market drops, they're holding enough vol contracts to offset that potential loss. So the only thing that's left is to say, what's the multiplier? Do I hold futures contracts for my equity exposure? Do I actually own stocks in the portfolio? What's the multiplier for the vol contract? Well, it's usually 1,000 for financial products. And there you simply just have to figure out, if you're holding futures, what's the multiplier on my futures? What kind of ratio do I need? And basically it could be different for different products, but that would be the approach. Just one final caveat, and I think as a disclaimer, it's very important. Once again, we must distinguish between using something like a volatility product, whether it's a VIX futures contract or a vol contract futures, compared to puts. Puts are absolute. If you own a put with a certain strike price and eventually settles to intrinsic value, you know that it's there. You know that it's hedging your downside. When you own something like a volatility contract, you can suggest that it will provide a hedge, such as the one that I've been discussing, but you get no absolute guarantee. 80% negative correlation is not 100% negative correlation. And it is possible, and we see such days, where stocks can be up and volatility can be up. And we do see days, although not a whole lot of them, where stocks can be down, and yet volatility can be down, especially if it has started from a rather lofty level. And so the concept that the hedge will be there, and working 100% of the time is a little bit less scientific than something like owning a put. I mean, I could give a very quick example. It's not something that's likely to happen, but just so listeners can clinch the idea. Suppose you own an equity portfolio and you want to hedge volatility for the next month, and the vol contract on an index is trading at, let's say, 20%. So you go ahead and you buy it, you pay 20 times the multiplier. And now you have a kind of extraordinary month where every day the market drops 1%. Well, that would be a disaster to your stock portfolio. You'd lose about 20% for the month, just drop 1% every single day. You'd lose a fortune. Meanwhile, the vol contract would not be providing any kind of meaningful hedge for you, because at 1% every single day, we already know that that's 16% annualized volatility, and the vol contract would settle at 16. Well, you paid 20 for it. So you not only lost 20% on your equity portfolio, but unfortunately, in this rather contrived scenario, you actually lost money on your vol contract hedge as well. Now, again, it's not likely to ever play out like that, but since I can describe it in words, it could potentially play out like that. And that's simply something that listeners need to be aware of in distinguishing the difference between an absolute hedge, such as a put, and a hedge using something like a volatility instrument.
And that's why I like you guys, Don, because you're free to point out the pluses and, of course, the occasional shortcomings and just areas where your product simply isn't applicable, and we don't see a lot of other people doing that. So that's why I like having you guys on the show. And of course, that's been an interesting discussion for us a number of times on this program and others in the past, is just whether to use, let's say, a pure volatility product, or to use, like you said, the absolute measure, which is the put, to put in some downside and some protection to your portfolio. And there's a lot of interesting debate on both sides of that coin, and maybe that could be a topic for a future show as well. We can dive into that some more and compare the various performances under various scenarios of, let's say, a S&P put versus a VIX versus a vol contract versus a few other measures that we could use in there. Might be an interesting conversation to have at a later date.
Absolutely.
All right, Don, thank you for that. And that is going to close out our Vol Viewpoint for this week. And now we're going to roll right into the mailbag.
Listener mail. Listeners write in.
Mailed in.
Mailbox.
And welcome to the mailbag. This is, of course, the portion of the show where we tear open the old mailbag and we see exactly what our listeners have in store for us. And today's question came in from Michael D. over in New Britain, Connecticut, not far from my old stomping grounds in Connecticut. And he asks about volatility on other indices. That's the subject of his email. And he writes, "Hello, VolViews crew," and hello to you, Michael. "Love the show. Keep up the good work. My question concerns the viability of volatility products on indices other than the S&P. For whatever reason, none of those products have managed to attract volume or attention like the VIX, even on the ones that were created by the CBOE. To what do you attribute their failure? Is there something inherent to those indices that make them poor candidates for vol products, or is the S&P simply an ideal candidate for vol products? Thank you for your insight." And of course, thank you for your email there, Michael. And I hope that you're not snowed in like everyone else over there in Connecticut, and that you have your power back. And Don, I'll take the first swing at this one. And this is an interesting question, and it's one that I thought was very timely for us just to discuss on the show, as well as for you guys over at VolX, because of course you are considering that very question right now. And a lot of people look at the VIX as this sort of explosion of popularity, and the way this product has just reached and hit saturation levels in various demographics and audiences that no one ever conceived of in the initial days of this product, including the retail audience, which I think a lot of people were surprised to see that VIX had so much traction there. But a lot of people don't remember the earlier days of what you might want to consider the dark days of VIX, when it was very much a different product. It was listed as the at-the-money vol on the OEX. It was not on the S&P, or was not on the S&P 500 anyway. It was the S&P 100. So the product itself kind of languished in obscurity for several reasons, and it wasn't until it did get that upgrade in recent years, and they changed the methodology a bit, which of course we discussed on last week's program, the pluses and minuses of the current way that the new VIX, quote unquote, is structured, and the fact that they added things like taking into account volatility skew, and they also added it to the largest and most widely benchmarked index on the planet, which is of course the S&P 500. And what relative percentage each of those products played in the actual success of VIX is an open question. There is a lot of people view VIX as maybe a lightning in a bottle, where this thing just took off and has been off to the races and never really looked back. And you're right, CBOE has launched other products, other people have launched other products on other indices, and they've never really reached those same lofty heights. But yes, personally, I don't think it was the index so much. I think that was part of the larger shift overall. People obviously pay more attention to the S&P than they do to other indices, and that certainly helped. I also think it helped with the professional audience, the market makers and others like myself, who really started taking notice of VIX when they changed the methodology to make it more suitable and take into account a broader spectrum of volatility than just front month at the money like they had in the old OEX contract. But personally, I don't think it was a inherent property of the S&P 500 that made the VIX the explosion of popularity that it is today. And also, I don't think it's an inherent property of other indices that they have maybe flagged and haven't caught up to the VIX in terms of popularity. And Don, of course, you guys, this question is very timely for you because you are, of course, considering this exact question and pondering this exact scenario right now as you ponder expanding into other indices like I won't name any ones because I don't know off the top of my head which exact ones you are considering for your new VolContracts, but let's just say you are considering a number of other indices and leave it at that. And Don, what's your take on this question as someone who, of course, is considering this right now in the marketplace?
Well, my take is, of course, that nobody would like to have the answer to it more than all of us at the Volatility Exchange, and we are, of course, going to see. I'll make a few quick comments. The first thing that I would say, even though I know VIX has become synonymous with S&P, when our listener writes, for whatever reason, none of those products have managed to attract volume or attention like the VIX. There's an implication there that VIX means the S&P 500 VIX. But VIX is actually the franchise name, for Volatility Index that can apply to any underlying. And they actually calculate the Euro VIX, the Gold VIX, the crude oil VIX, and the S&P 500 VIX. So these are all VIX products, but public has come to call the S&P 500 VIX just VIX for short because, as our writer correctly points out, there really has not been any trading or any success in futures products that are, in fact, VIX futures on any of these other underlying. So,
that's true. VIX is, of course, the brand name, and I think part of that is, of course, to capitalize on the success of that main product. And of course, many people do view that as the VIX when indeed you're right. It is more of a family of products if none of them have ever really managed to catch on the way that first initial product has.
Right. And so now this is the $64,000 question. And again, we obviously have a point of view and our opinion at the Volatility Exchange. And time will tell exactly where the truth might lie. But our contention has been from the very beginning, and the whole reason for having created a realized volatility product in the first place, is that there are a great many issues with the VIX methodology and the VIX approach and the whole use of implied volatility for basing all of the trading products and the eventual settlement and all the things that we've been discussing. So we feel that we've built a better mousetrap, and that the way traders and hedgers and speculators ought to be trading volatility is with the actual volatility of the underlying that can be calculated and delivered by formula with a certain amount of a degree of certainty. It's our contention, therefore, that most of these other products on volatility that VIX have brought out have not been successful, not because there isn't interest in trading volatility in those other underlying assets, but that there's a great deal of disenchantment with the actual VIX methodology. So if you say, well, if you claim that, how come people aren't disenchanted with the methodology on the S&P, and why is that so successful? Well, they are disenchanted, but they trade it despite that disenchantment, because up until now, it's been the only game in town. And as such, as you mentioned, the most widely followed, most liquid, most heavily traded benchmark, perhaps in the entire world, there is a greater interest in trading any kind of volatility product on the S&P, even if it's a somewhat flawed product, than there would be to simply say, well, we protest, we rebel, we're not going to engage in the trading of this product. So that's the big question. And again, we have our viewpoint that, yes, the public will be inclined to trade realized volatility products on an entire array and host of underlying assets, even though they haven't been so inclined to do so with VIX. And again, time will tell.
It will indeed, as we look into the future and see exactly what you guys have cooking over there at Volex for the near future. And speaking of looking into the future, we're going to close out our mailbag for this week. And thanks again for that question, Michael. That was a very interesting question. And now we're going to dive right into our crystal ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball segment. This is, of course, the portion of the show where we gaze deep into the murky ether of the future and attempt to divine what the markets and indeed the world of volatility has in store for us. And we discussed earlier in the volatility review portion of the program, Don, that the S&P had a bit of a wild ride while I was on vacation last week. We saw vacillations in the S&P, the VIX cash, all the way down from mid to low 20s all the way up to about 32. Of course, we were trading almost exactly at 32 in the VIX cash. Today, as we started the show, we've since sold off about a point since we started talking. VIX cash hovering around 31 even right now, only up about 2.8% on the day. The S&P is about unched right now as well, trading down merely a handle. So we're starting to see a little bit of a reversal of fortunes in the market today. So we talked earlier, Don, about needing that 25 handle swing to justify our current VIX levels. Maybe we'll get it to the upside today. Who knows? But we're not seeing it right now to the downside in the old VIX. And personally, and looking at all of our positions, I don't know, maybe you have a different perspective, Don, but I haven't really been too much of a fan of what we've been seeing over there in Greece and in Europe, and that's led me to, even though this is a relatively high level of the VIX right now and does call for serious intraday movements in the S&P, I don't see any lessening of this in the immediate near term. I fall on the same tip as the futures do, where on the longer term I expect these VIX levels are unsustainable. But I suspect in the near term, which is probably the next month or two, we're going to see continued vacillations as the Eurozone continues to fracture and fragment and melt down. And I don't see this VIX of 31 here really selling off substantially again over the next few months. We might dip down to that mid-20s level off some occasional good news, but I personally am a bear here. I'm not a fan of these levels. I'm not a fan of this market right now. I think we're looking down before we look up again. So I think this VIX level right here is where we're sitting for at least the near term. Don, do you have a dissenting opinion? Where do you fall right now in overall volatility levels in the S&P?
Well, I think it's awfully high, and I really do think that it's very possible that sentiment could be that it stays high for the foreseeable future with so much uncertainty coming from Europe. But again, this kind of points out the great, I won't say disparity, but simply the inherent differences between trading an implied volatility product and trading a realized volatility product, because it's very possible that VIX, which is just sentiment, could stay this high sentiment and stay at 32 for the next month or more so. That's a different question than if you asked somebody, would the actual or realized volatility of the S&P cash index be 32% for the coming month? So it makes an interesting, even, a spread type of trading opportunity.
It does.
Somebody might feel just the way you do, and perfectly justifiably so, that sentiment could remain at this level and they'll keep trading the futures there, or maybe even higher. But then if we apply our formula to the next, 4 weeks of trading, and I say, hey, Mark, I'll see you in 4 weeks. Let's see what the volatility of the S&P was from a standard deviation mathematical point of view. Here I, once again go out saw myself a little limb and say, I'm not so sure we're going to get 2% a day, 25 points on average every day for the next 20 days, so that the realized volatility of the S&P will be 32 when we check in, at the beginning of December. So that makes for the interesting discussion.
That point you outlined is exactly the dichotomy. It's the difficulty we have to wrestle with every week as we look at this S&P and just the general volatility conditions and try to make our prognostications, because I agree with you on the purely empirical mathematical side. These levels are unsustainable, definitely in the long term, perhaps in the near term. But VIX has that other component, like you said, because it is implied and it does have this broad following, that there is a strong sentiment aspect to it that cannot be overlooked whenever you're making some sort of future prediction of where VIX will be. So that's why I hedged my bets, as it were, to say that in the long term, I don't think these levels are sustainable, but in the near term, you can't overrule, you can't ignore that sentiment factor, which plays such a key level in VIX. And so, given everything we're seeing right now and given all the sentiment we're seeing right now, I don't think these levels are going to go away anytime soon. So there you go. I've hedged my bets, sir.
And you're probably right. And, we might segue right into the euro, since we're sort of in the crystal ball segment anyway, where I'd be asked to give some opinion there. And again,
you're taking over the host seat, sir. Should I just sit back and sift in my brandy sifter and let you run the whole show? That'd be nice. Another vacation for me. It'd be fantastic. No, by all means.
Your next question.
By all means, segue, sir.
Well, I pulled up one of our volatility cones for the euro, and I went back a good 10 years, and I took a look at the 90th percentile, which is always a good place to start, and it's 13.83. So, you can make a statement that 90% of the time, 1 month volatility, that's actual or realized volatility in the euro, has been less than 13.83, certainly less than 14. Well, here we are sitting at 15.03 for the December contract on the first settlement price before we start entering into the calculation period. And again, these are crazy times. You might say it's going to go on for the whole month. And as we look to Europe, it may very well be the case. And so you might say 10 years worth of data is great, but it doesn't correspond to what's going on in Europe this particular month. And, that's what makes it all interesting. But whether or not you can have this 15% volatility last for the whole month will remain to be seen. And it's kind of interesting that when you look at some of the forecasting mechanisms, such as Robert Engel and the Volatility Institute over at NYU, his forecast is 13.47 for an actual settlement or expiration value for this front month December contract. So again, always fun to look at some of these instruments that we use to help us make decisions and try to speculate as to what might be.
Always fun to read the tea leaves, as it were. And listeners, we are joined here in the closing minutes of the program by good old Mark Sebastian, our volatility pit reporter from optionpit.com. And Mark, Don and I were just discussing earlier in this Crystal Ball segment our outlook for general vol here and the VIX and just vol in general. And we were discussing the fact that we think in the long term that these levels are unsustainable. We agree with the futures that this is just a peak here. But at the same time, we have this level of sentiment that cannot be overlooked. And I don't think, at least anytime in the near term, that these VIX levels are retreating very substantially to the downside, and certainly not much south of that 25 level or so they hit last week. Are you on that same boat, or are you a dissenting opinion?
I'm going to sound really draconian here because I think things are lining up for a really ugly ride. I think we got another...
Draconian? I'm amazed, sir.
I know. But I'm looking at a combination of gold markets, credit markets, and option volatility. I think things look really ugly. All of the smart paper or the hedging paper or the safety nets are seeing their prices really expand. And I think that's really bad news for the market.
Well, thank you for that, sir.
Did it get in? Did it get in?
It got in.
All right.
Technical difficulties aside, Mark was able to join us at the last minute here, and that is indeed going to do it for this episode of Volatility Views. I want to thank my boon companion here, good old Don Schlesinger from the Volatility Exchange, for joining me today. And Don, before we go, are there any interesting developments or updates you guys have coming up over at volex.us you'd like to let our listeners know about?
The only thing that I'd like to say is it's been a few weeks since we have had guests on the show, and I know that from mail, listeners always like other points of view and to bring on prominent guests. We've actually outlined the potential for having quite a few in the near future. I'm in the process of corresponding with several people who have agreed to come on the show. I think they are all extremely interesting from point of view of their interest and participation in volatility studies. And as quickly as we can line up the dates and book them for the show, I'm hoping that we will have quite a few in the next month or two. So bear with us as we get people from all walks of volatility to come on to the show, and hopefully we'll have some lively discussions going forward.
Always fun to add some new voices to the mix, so it's not just you and I bantering back and forth there, Don.
Well, I'm gonna sit down. I'm gonna sit down with Bob in Vegas, whether he likes it or not. Bob and Charlie.
Yes, that's right. Little... Thanks for reminding me of that, Mark. We have the trade show out in Las Vegas. I'm not able to make that one, but Mark Sebastian will be there. Our CEO, Bob Kraus, will be there. Yep. And we've already talked about the two of you sitting down and doing the show for that following week in the middle of November. So listeners can look forward to that as well.
Is Charlie going to be there as well?
Yes.
Listeners, if you get a chance, ladies,
the man crush continues.
Ladies, you've got to see this guy, Charlie. He is an attractive man.
Of course, listeners will also be sad.
Alex, they're the smartest, best-looking group out there, best I can tell.
Of course, listeners won't have a chance to see Don in his booth babe get-up. So that, if you're talking attractiveness, Don's missing this one, listeners. So you had your chance here in Chicago last month. But with that image in mind, that is going to do it for this episode of Volatility Views. I, of course, want to thank all of our listeners out there for downloading and streaming and subscribing to the show and making it such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.